Morning. My name is Desmond Lockman, and I'd like to welcome you to this morning's discussion of whether the dollar might be losing its dominance in global markets. And I'd very much like to welcome our truly distinguished panel of experts to discuss this timely issue. In the order in which they'll speak, they're Mori Obstfeld, who is formerly the IMF's chief economist and who's now a senior fellow at the Peterson Institute. He'll be followed by Jeffrey Frankel, who is an internationally recognized professor of economics at Harvard's Kennedy School. Nathan Sheets will be the next speaker, and he is a former senior Fed and US Treasury official, and he now is the chief economist at Citibank. And last will be my AI colleague and good friend, Steve Kamen, who is also formerly a senior official at the Federal Reserve. Just by way of introduction, I'd say that it would be an understatement to say that this second Trump administration is following a radical and highly unorthodox set of macroeconomic policies that are bound to have a lasting impact on the dollar. Import tariffs have been hiked in a chaotic manner to an average 18.5%, or to their highest level in 100 years. Trump's one big beautiful bill is estimated to add around $3.5 trillion to the already large budget deficit over the next decade. That would take the public debt to GDP ratio to a Greek-like 128% by 2034. Meanwhile, Trump is going out of his way to undermine the independence of the Federal Reserve, and he is pursuing an immigration policy that is bound to cause labor shortages in the agricultural and construction sectors. As if this were not sufficient reason to be concerned, he's raising questions about the US commitment to the rule of law and to the honoring of its Treasury bond obligations. So far, the dollar, gold, and bond markets have not reacted well to Trump's macroeconomic policies. Since the start of the year, the dollar has lost around 10% of its value, marking its worst start of the year since 1973. Meanwhile, gold prices have now spiked to an extraordinary 45% since the start of the year, and US Treasury bonds seem to have lost their appeal as the world's leading safe haven asset. In assessing where the dollar might be headed, it's well to remember that the international role of the dollar and the value of the dollar in foreign exchange markets are two different things. Since the 1970s, the value of the dollar against foreign currencies has exhibited wide swings, but has nonetheless remained the world's dominant currency for international payments and investment. Today's Trump's policies seem to be both weakening the dollar's dominance and pushing down its level in foreign exchange markets. Still, it's difficult to know what currency might take its place. Since weak as the dollar's fundamentals might appear, those of the euro, yen, and Chinese renminbi do not appear to be too good either. In Europe, France has public debt dynamics that look as bad as those in the US, and is presently suffering from political dysfunction. Meanwhile, Japan has very much higher public debt levels than the US, while China's economy is being adversely impacted by the bursting of its property bubble and by Trump's punitive import tariffs. All of this raises a series of questions. How is the dollar's recent weakness to be explained? Could this be the beginning of the US dollar losing its dominant role as the world's leading international currency? Second, how serious a threat is the US unsustainable finances to the dollar? Third, can the euro and Chinese renminbi pose a serious challenge to the dollar? Fourth, what might the spike in the gold prices be telling us about confidence in the dollar and about the international reserve preferences of the world's central banks? Fifth, does the weaponization of US financial policies and the growing popularity of cryptocurrencies pose a long-run threat to the dollar? And finally, is there any merit to the Mar-a-Lago Accord's objective of depreciating the dollar? Does the US need a weaker currency to close its trade deficit? Uh, Before I turn it over to our first speaker, Mori Obstfeld, might I say that if anybody in the audience has questions, they can email them to jack.rowing@ai.org, which is on the event announcement. So without further ado, I look forward to hearing what Maury's got to say on the matter.
Great. Thank you very much, Desmond. It's a real pleasure to be here on this AEI panel with so many good and old friends to talk about the dollar. And when I say slowly, then quickly in the title, I'm alluding to both Ernest Hemingway, uh, How Did You Go Bankrupt? Slowly, then quickly, and Rudy Dornbush. Crises uh, uh, seem to develop more slowly than you think until they actually hit. So let me advance this. The U.S. dollar's primacy is based on a number of factors, and we all know this: deep open markets, the U.S. commitment to multilateralism, including in the security sphere, a strong policy framework based on central bank independence, producing price stability, as well as a fiscal framework that has so far at least seemed consistent with solvency, a commitment to markets and market resource allocation, and very importantly, the rule of law. Um, but the present administration has turned to a set of policies uh, which Desmond has outlined in his introductory remarks, based on a grievance narrative. According to this narrative, global trade has been unfair to the US and has been the cause of trade deficits, uh, very persistent deficits, and manufacturing decline. Global capital markets also have elements of unfairness because they take advantage of using the dollar and accessing US financial markets. This makes the dollar stronger and again penalizes manufacturing and swells the deficit. Uh, the US burdens of global uh, security, including uh, foreign aid, have been expensive and unfairly shared. Now, these basic concerns are not new. If you go back throughout most of the post-war era, you can see the US administrations expressing these concerns. But the approach to redress them through a zero-sum policy is new, and so is the routine use of tariffs to coerce other countries, including close allies. Um, I don't think it's hard to refute these grievance narratives, certainly at the aggregate level. Uh, there are many indicators one could examine. One is simply the fact that at market exchange rates, the US share of global GDP has been constant over decades. Now, this partially reflects exchange rate developments, but still, it's a remarkable fact. And if you ask where has China's gain been offset elsewhere in the world economy, it's really other advanced economies, not so much the US. One can talk about distributional effects within the US, but to blame those on foreigners when US policy has tools to offset those seems uh, rather one-sided. Um, I would argue that the international monetary and financial system is now at a pivot point. And the dollar's uh, role, the subject of this seminar, is, I think, a good prism to look at these fragmentation risks because the dollar's dominance is one of the most prominent expressions of the integration of the global financial system. Um, there's a long list of problems here. I won't linger on any one of them, but I think countries are going to want to insulate themselves from U.S. policy volatility and U.S. coercion, which will imply less integration with the U.S. economy and maybe less integration outside of the U.S. Tariffs are a big part of this. The assaults on the Fed's independence are bound to undermine the strength of the dollar and the willingness of the world economy to rely on the dollar. In fact, the only central bank independence that the administration seems interested in is independence from good and accurate data. The enhanced executive oversight of the financial regulatory functions of the Fed and most recently the Treasury Secretary's attack on the entire idea that the Fed should have a role in financial regulation is bound to undermine the dollar, as is a likely pullback from aspects of international regulatory cooperation and international support for the dollar, including the presence of swap lines. I believe there is a risk of increasing U.S. control over capital inflows and outflows. And when we see arrangements such as the export tax on NVIDIA and AMD, it underlines the risks of much more wide-ranging interventions. Uh, the U.S. has been a leader in trying to enforce rules against money laundering, foreign bribery, etc. That's now off the table. I'm sure we'll have more discussion of the Genius Act and stablecoins. The Treasury views this as a way of advancing the dollar internationally and perhaps increasing the demand for treasuries. But I think foreign countries are likely to resist the vulnerabilities that widespread domestic use of private dollar stablecoins would entail. And this could lead to fragmentation, not integration of cross-border payments. Um, the U.S. security umbrella plays a key role in underpinning the dollar's primacy. There, we're seeing a much more volatile security environment. And finally, fiscal indiscipline. Desmond mentioned the OBBBA, which may push the U.S. indeed toward triple B status in the credit markets. This, together with the assault on Federal Reserve independence, leads to a real risk of fiscal dominance. And it's important to underline just how reliant the U.S. is on tariff revenues to prevent a total lack of control over the debt to GDP ratio. Uh, if the Supreme Court strikes down the IEEPA tariffs, this could lead to a reaction in bond markets, and we could see a spike in Treasury risk premia that would impair the safe haven quality of U.S. obligations. As it stands, uh, foreigners hold about a third of U.S. Treasuries outstanding now, and this is sharply down from the roughly 50% they held just after the global financial crisis. And so we have to ask how these accretions of Treasury issuance into the global markets uh, will affect yields. Um, uh, if U.S. savers with their very low saving rate have to absorb the bulk of these, uh, the resources could come from crowding out a reduction in investment or from a reduction in foreign asset holdings. But for the latter to happen, there has to be a combination of higher treasury yields and a depreciated dollar. So I believe going forward, the deficits will have strong asset market effects, all the more so if tariff revenue should become unavailable or be less uh, lucrative than the administration would wish. Generally, I think the deteriorating Treasury funding environment has been an issue. The correlation between stock returns and bond returns has become more positive, more unstable. This reduces the safe haven properties of bonds, and the same is true of a correlation of global shocks, which now are becoming increasingly U.S. shocks and U.S. capital outflows. We saw this very dramatically after the Liberation Day tariffs. More secularly, there has been a falling convenience yield on longer-term treasuries, and this has been going on since the global financial crisis, and with it, lower seigniorage at the long end due to increasing treasury supplies. And there's a large range of studies, some of which I list here, which point to this. The Treasury is likely to move and has been moving to more short-term issuance. That increases rollover risk and the risk of a market uh, uh, reaction to a failed auction, which could set off problems in the Treasury market. I just want to notice one aspect of stablecoin use that people like Ken Rogoff have emphasized. Uh, Roughly $1 trillion in US currency circulates outside of the US, much of it in the underground economy. It's a potent source of about $40 billion a year in seigniorage at current interest rates. If the underground economy migrates to the stablecoin realm because it is less regulated, this seigniorage will go to stablecoin issuers. A final fiscal threat is just the fact that higher interest rates globally seem to be on the table with higher military spending in Europe and more fiscal stimulus in China. So a rise in R star would be a bad thing for US fiscal sustainability. Looking at all these elements, I am led to ask what Alexander Hamilton would say. Hamilton set the fundamentals in place for the U.S. to be a credible issuer of debts in international markets. This was the whole point of his scheme to have the federal government assume the debts of the various states. And in his report on the provision of public credit from 1790, he wrote, "States, like individuals who observe their engagements, are respected and trusted, while the reverse is the fate of those who pursue an opposite conduct." And the U.S. Is transgressing its engagements in a wide variety of spheres these days, as well as raising concerns about whether it would observe the most fundamental of its engagements, the one Hamilton was talking about, to repay its debt in real terms with stable dollars. I would argue the U.S. has aspired to this standard, perhaps imperfectly, over its history, and it's fashioned institutional anchors in pursuit of this ideal, but these anchors are under threat now as rarely as before. The U.S.'s dollar's role is supported by strong network effects, and network effects can enhance the dollar's stability. But the nature of network effects is that, one does what everyone else does. And when others stop doing it, the network can collapse very quickly, which is why I would say that change in the dollar, if it comes, will come slowly, but don't rule out the possibility at some point that there is a tipping point where the system changes and a multipolar system emerges. The euro, the RMB cannot replace the dollar, but a multipolar system could certainly emerge. Let me stop there.
Maury, thank you very much. That's just, you've covered just a tremendous amount of ground, and you've just raised a whole load of issues, and I'm just the panelists at a later stage, I'm sure will have something to say about it. Just a couple of questions. Just in terms of the dollar and the trade deficit, is there any prospect that the US trade deficit narrows, at a time that its budget is blowing out, that I would have thought that the trade deficit is really driven by the saving investment balance, so whether the dollar depreciates, if it's in the context of highly irresponsible fiscal policy, I'm not sure. I just wonder whether there's going to be a repeat of what we saw in the first Trump administration of, despite tariffs, you had a widening of the trade deficit because the budget was out of control. Uh, the second thing, I'm just curious, how do you think this whole thing plays out? I can see the case for a bond market crisis, that the US has trouble funding. Uh, but I'm not sure about where the dollar goes, because I'm not sure that it's got a replacement in terms of the other currencies.
Mhm.
That the euro just seems to be terribly troubled right now, with what's going on in France. China just doesn't looks like it's a non-starter, so I, I, I I just wonder whether that is what's driving a 45% increase in the price of gold. People don't know which currency to go to, so they're getting out of currencies and into gold. I mean, the
Yeah,
same thing with the cryptocurrencies.
yeah, absolutely. Yeah, it's ironic that people think that Bitcoin is the best hedge against the dollar in some circles. Let me talk about the macro first, because this is super clear. Like it's just super clear, and no one in the administration seems to get it. So, yes, the increase in the deficit, particularly if tariff revenue doesn't live up to expectations, is going to uh, impede trade balance adjustment. Um, Now, I would argue that in order for the U.S. to adjust its trade balance uh, deficit downward, we do need a real depreciation, but that has to come about from a reduction in U.S. spending relative to income, an increase in spending relative to income in the rest of the world, particularly in Europe and China. Now, what happens if the dollar continues to depreciate, say, because there's pressure on the Fed, but we don't see the underlying reduction in overall spending absorption relative to output? The answer is we get inflation, and that inflation offsets the nominal depreciation by reducing the resulting real depreciation, right? So we need real depreciation of the dollar to adjust the trade deficit, not nominal depreciation. And nominal depreciation without an underlying adjustment in the saving investment balance will simply lead to inflation and a rise in the price level, which prevents real appreciation. So I think that's the basic macro of where we are. So you can't just say, we're going to weaken the dollar. That'll fix everything if you don't adjust the underlying saving investment balance in real terms. On the issue of where do people go, uh, it's true that uh, the RMB has issues. We worry about the rule of law in China, the closed capital markets, but China is working very hard to expand the reach of the RMB. And many countries with a heavy weight in GDP, global GDP, are heavy trading partners with China and are worrying about dollar holdings and be willing to explore closer links with the Chinese system. That's just a fact. You look at the leaders who went to China last weekend. These are all countries that while recognizing the shortcomings of the RMB, are eager to reduce their vulnerability to U.S. volatility. I think the Euro zone obviously has economic and political headwinds, but there is a desire there to raise their game, which they also view as a security imperative in view of Russia's threat. And so I wouldn't rule out that there's more progress in, for example, setting up a unified European payment system, moving euro stablecoins uh, uh, forward in um, uh, some fashion. And frankly, European policymakers are telling banks, please reduce your dollar funding, please reduce your dependence on the dollar, because we don't know that the swap lines from the Fed, which support dollar dependence, are going to be available. The Fed's independence is under threat, and it could increasingly be at risk of being used for international coercion, just as the tariffs are being used to coerce foreign countries, uh, not just to lower trade barriers, but to make large sums of money
Yeah.
available at the Trump administration's discretion for so-called investment purposes.
Yeah, just to add to that line of thinking, I guess the fact that the US is weaponizing the dollar, with what they've done with the Russian assets, what they've done with the Iranian assets, that's probably another reason why people might want to get out of the dollar.
Mhm.
Uh, Jeff, just Mori, once again, thank you very much. That was a great presentation. Uh, Jeff, would you like to start?
Yes, thank you. It's a pleasure to be participating in this panel on the dollar. Let me share my slides. Are they shared?
Yeah.
Is it full screen? Okay, here we go. This is very topical. The question has been with us for some time, the role of the dollar, whether it'll sustain its role as number one international currency. These fine books written very recently show you how much attention the topic is getting, both in the media and from scholars. I agree with pretty much everything that Desmond and Maury said. I'm going to organize my comments by trying to answer the 6 questions that Desmond posed to us at the beginning. Number one, why the dollar's recent weakness? I think that we economists could confess that when Trump was first elected, we were overconfident in our predictions that if Trump went ahead with his tariffs and they reduced imports substantially, that would mean a fall in demand for foreign exchange and thus cause dollar appreciation. The logic is right, and I do think there's be substantial offset of the reduced imports on reduced exports, but there are other channels. And the fact is, exchange rates are too vulnerable to unpredictable factors, particularly financial factors, to justify going out on a limb and making predictions. And of course, the dollar has gone down quite a bit since inauguration day, since January. Why is the dollar depreciated? I see 3 possible reasons. First, the increased likelihood of a recession, although that was more of an issue, seemed to be early in the year than now, but I think it's still an issue. Second is uncertainty created by the Trump chaos, which we've heard about, and I will say more about. And third is expectations of inflation. As Desmond pointed out, the price of gold has risen a lot since January. That's consistent with explanations 2, that it's uncertainty and risk, or explanation 3, that it's inflation. It's not really consistent with the possibility of recession, or that's a dominant factor. Trump is entering dangerous new territory on all kinds of fronts. To name 3, tariffs, policy vis-a-vis the Fed, and then Doge kind of reckless and chaotic cutting of government employment. Second half of Desmond's first question was, is the dollar losing role as a leading international reserve currency? Here are the data on reserve currency shares. The dollar is still easily, by far, in number one position, but there has been a slow, gradual downward trend. This is showing the share of central bank holdings of international reserves or foreign exchange reserves that are in dollars. And I'd say this downward trend has accelerated since 2014, which perhaps not coincidentally was the year the first Russian invasion of Ukraine and the first application of U.S. sanctions against Russia. You see the other currencies are still far below, including the euro, which in fact has lost some share. Question two, what role for U.S. debt? We are on an unsustainable path. We're already pretty much at the record level of debt to GDP, and the path is for lots of reasons, nothing but upward and perhaps sharply upward. So for reasons that we've already heard, I do think that this is a threat to dollar dominance. We might have finally exhausted the willingness of global investors to accumulate limitless treasury bills at low interest rates. It seemed like it was no limit to that, but perhaps we're now hitting the limit. We may become like other countries where eternal deficits, if they're not corrected, eventually require monetization and currency depreciation, something other countries are very accustomed to, but we're not. What about the role of the renminbi and the euro? Will they supplant the dollar? As we've heard, neither the Eurozone nor China has the financial markets that would be necessary to challenge the dollar for the number one position: depth of financial markets, liquidity, openness. To be sure, as central banks have been shifting out of dollars, they've been moving a bit into renminbi and other smaller currencies, a bunch of smaller currencies, a New Zealand dollar, Australian dollar, Swedish kroner, Korean won, and some others, which add up. Not into the euro, as we saw in the previous graph, that actually the share going to the euro has fallen. A lot has gone into gold. Gold is an international reserve. It's not a foreign exchange reserve, but it's an international reserve. And central banks have shifted out of currency reserves or foreign exchange reserves into gold, especially in Asia, but in Russia, but elsewhere also. All of these still lag far behind the dollar, although gold might be catching up. Here's a graph of the big aggregates. The share to dollars has been diminishing slowly. That has not gone into euros, rather it's gone into gold and into the other smaller currencies. What might this tell us about the confidence in the dollar? What's going on in the gold market tell us about confidence in the dollar and about the international reserve preferences of the world's central banks. The strong rise in gold prices since January is consistent with a loss of confidence in the dollar, arising from either increases in inflation or risk, or fear of sanctions and risk and uncertainty attached to the inflation and sanctions. So these are overlapping explanations. Mori spelled out in more detail, but I'll just do some of the highlights of how U.S. chaotic policy making is playing into this. The world is reacting to lawless and unpredictable U.S. policies, tariffs and financial sanctions in particular, by shifting out of dollars, as we've noted, into smaller currencies and gold. And to be fair to Trump, the financial sanctions, including perhaps abusive financial sanctions, are going too far with him. It predates Trump. It goes back, I would say, to actually that was Trump the first time around when we withdrew from the nuclear agreement with Iran and we returned to sanctions. I would say that was an abuse of the U.S. exorbitant privilege and an abuse of sanctions. But the trend, as I say, has reversed to some extent since the turn of the century, but especially since 2014. Here, my list is not as detailed or as enlightening as Maury's, but here are some of the lawless and unpredictable policies that I have in mind. Crazy tariffs with ever-changing tariff policy, gratuitous ruptures with allies in other areas as well, quitting international institutions, pressuring the Fed to inflate, and flirting with default or with taxing foreign-held U.S. debt. Cumulatively, these policies are accomplishing what very recently I would have said is hard to accomplish. I would have said the dollar is so entrenched, there's such an absence of alternatives, and is so entrenched in the leading international currency role and the U.S. hegemony of the U.S. leadership of the international system more generally, that it's not going to be defeated. But each of these policies has been a blow from a sledgehammer, and I think the dollar's once unshakable primacy is clearly being challenged now. I'm going to present briefly some results of some recent work I've been doing with Menzi Chin and Hiro Ito of the currency composition of international reserves. Most earlier studies only had aggregate central bank holdings of reserve currencies instead of breaking it down by holder by individual central bank. More recently, it's become possible to get data on case by case, country by country, or central bank by central bank data, which allows additional determinants of holdings, such as the vulnerability to bilateral sanctions. Different countries are at different levels of vulnerability to U.S. sanctions in particular, and presumably the ones that are more vulnerable would be the ones who would shift more. And now it's possible to include gold. And this paper I'm going to mention, which is new, includes gold among the international reserves. So a lot of results, but just to give a few highlights. U.S. financial sanctions do reduce the dollar's share significantly in a logit regression. The imposition of sanctions is associated with a 1.4%, this is a dummy variable, with a 1.4% reduction in the dollar shares in the short run and more in the longer run. Sanctions typically appear unimportant for other currencies. We weren't able to find an effect for others. U.S. trade policy, Section 232, that's a national security basis, tariffs, we couldn't find a significant effect on currency holdings. However, U.S. trade policy uncertainty is associated with the 2018-2019 trade war, the Section 232 tariffs in particular, did affect the reserve shares, reduced the U.S. share. It's uncertainty that seems to show up the most strongly in our results. Uncertainty with respect to U.S. trade policy, uncertainty with respect to U.S. monetary policy, and global economic policy uncertainty. So here's just a sample table. You can see the highly significant results, the three asterisks for global economic policy uncertainty, monetary policy uncertainty, and trade policy uncertainty. And this is explaining the demand for gold, consistent with the shift into gold. Lastly, last of 6 questions that Desmond gave us, is there merit to the Mar-a-Lago Accord, which of course is a fictional, it's a notional thing. Its objective of depreciating the dollar. Does the U.S. need a weaker currency to close its trade deficit? Well, I think Mori said it very well. Dollar depreciation boosts the price competitiveness of U.S. products internationally. So it's true that that works to improve the trade balance, other things equal. And yes, if we were to eliminate the trade deficit, a dollar depreciation would probably have to be part of that. But we don't want to do it via something like the Mar-a-Lago Accord. The instrument there was threatening to, in essence, default, not those words, but you make unilateral changes in the terms of U.S. debt internationally, and that really is threatening default or taxing foreign holdings of U.S. Treasury securities. We shouldn't want to do it that way. For one thing, it would be inflationary and would accelerate the diminishing attractiveness of dollar assets. As Maury said, fiscal retrenchment needs to be part of the equation. which would reduce the budget deficit, thereby reducing the interest rate, and that should bring down the dollar as part of the equation. Okay, those are my comments.
Jeff, thanks very much for those comments. It looks like you're in agreement a lot with Mori on where we might be headed. I've just got a couple of questions. The one is, if you eliminate the trade deficits in the United States, what that means is you've got to be reducing the amount that the United States is spending. That basically the exorbitant privilege of the dollar has been allowing the United States repeatedly to spend more than it takes in. So that the objective of getting rid of the trade deficit really just seems to be a major issue. That would be if you don't adjust otherwise, you're going to be getting inflation. But that's the one question I've got. The other is, just how do you think this thing's going to play out? And I just want to throw one thing into the mix. It seems to me that if you get real problems in the bond market, that is going to have huge implications for the stock market. That currently what you've got is you've got equity valuations that look like the 2001 dot-com bubble. If you get higher bond rates, higher bond yields, you would expect that is going to deflate that kind of bubble. But I'd just be curious, how do you see this thing playing out?
Okay, on the first question, this has been with us quite a while. I remember in the 1980s when the U.S. first started running record trade deficits, and Marty Feldstein made famous the twin deficits, that the U.S. budget deficit was causing low national saving and going up as a current account deficit. And we've been living with that ever since. I remember in the 80s, there was a debate. Some said that we needed to depreciate the dollar, and some said, oh, that's ridiculous. It's saving minus investment. But those are not inconsistent statements. If you had a major depreciation of the dollar without cutting back U.S. spending, government spending or otherwise, that would raise demand and we'd go into inflation. And that's not what we want. If you conversely, if you do it solely by cutting national saving, cutting spending, and increasing national saving, rather, that would cause a recession. And yes, it would have worked to improve the trade balance. And yes, arithmetically, that means saving minus investment would increase. But we wouldn't want that because it would be a Great Depression, a recession anyway. So you want to have the dollar come down as a result or in concert with a shift in the monetary fiscal mix. Your other question, the stock market, I mean, it's a little bit of a problem for our narrative that we're all making here, that the stock market has gone up so much this year. But my conclusion is, as I think yours, Desmond, is the stock market is just overvalued. I mean, I have to admit, I've said that before, but relative to any measure, whether it's price earnings ratios, dividend yields, Tobin's Q, stock market relative to GDP. The stock market is at very high levels, and I could see it going down rapidly with all kinds of possible triggers. Yes, the bond market is one possible trigger, and a crisis of U.S. funding. If we have a case of a fiscal cliff or government shutdown, or further downgrading of the U.S. debt, that is one of many things that could trigger it.
Right. Well, I guess this is a good segue into Nathan. But just before that, one observation I'd make is that the administration keeps complaining about foreigners becoming so wealthy at the United States expense because they're building up all of these assets in dollars. But the truth of the matter is that what the foreigners are doing is they've been allowing us to spend more than we've been earning for many years. So we've been getting a huge amount out of this. I just find it odd the way in which they're saying the foreigners are gaining at our expense in terms of the assets that they're building. But basically what they've been doing is allowing us to go wild with our credit cards. But that's just an observation. Nathan, would you like to take the floor and perhaps tell us whether the equity market is a bubble?
I'll get to that one, Desmond. Absolutely. Well, it's wonderful to be here. I really appreciate the opportunity to be part of this panel. And many compliments to you, Desmond, for your framing of this, but also to Mori and Jeff for really, really excellent presentations that have covered a lot of the ground. I think I share a lot of the concerns that they articulated. Desmond, this would shock you. I probably land in a place that is, while concerned, a notch more optimistic about the dollar and the dollar's prospects. But kind of let me outline my thinking here. What I'd like to do first is just kind of put forward a few kind of definitional sort of framing thoughts that draw on several observations that have already been made that I think are important. I very much agree that when we think about dollar dominance, when we think about the exorbitant privilege, the root and core of that is this reserve currency issue. And I think reserve currency, we use that as shorthand, particularly for the dollar's role as an international store of value, but also the dollar's role as an international unit of account, as an invoicing currency, and some of the safe haven features of the dollar. And I think this reserve currency status has manifested itself and broadly continues to in the dollar's use as a third currency or vehicle currency in many foreign exchange transactions in foreign countries, foreign central banks, decisions to hold reserves in dollars role in FX, debt instruments and cross-border transactions and the like. But also importantly, I think we see the reserve currency status of the dollar manifest itself in the size of foreign and the robustness of foreign participation in U.S. financial markets. Now, having said that, I very, very much agree with Mori that kind of what I've just described is the narrow kind of set of issues related to reserve currency status and dollar dominance. But there's kind of this broader underpinning of institutional arrangements, prestige and influence of the US and US economy, and a whole range of issues, economic mass of the US, its diplomatic influence, cultural influence, military strength, rule of law, that whole set of institutions and influence that are supportive of the dollar, but somewhat separate from it. I also just briefly want to underscore a point that you made, Desmond, in the overview, is that the dollar's reserve currency status, and if you will, its dominance, I think is broadly a separate issue from the value of the dollar in foreign exchange markets at any given point in time. I think you're absolutely right. Over the last 50 years, we've seen the dollar sometimes strong, sometimes weak, but through that period, it has been uninterruptedly the reserve currency for the world. Now, maybe where those thoughts come together and where there's relationship is that if a currency is the reserve currency, that should bring an extra slug of demand for that currency and for assets denominated in the currency, which should mean that on average over time, the currency is somewhat stronger than it would be otherwise. But I think it's important to differentiate those thoughts. Now, let me move on and just briefly articulate what I would call kind of the old-time religion regarding the argument that the dollar's reserve status is robust. And typically, this argument ends up and will remain robust for coming decades. And to be candid, I still find many of these arguments to be quite persuasive, but I also take some of the cautions and caveats from Mori and Jeff, and I'll touch on those in a moment. But kind of the old-time religion on the dollar, I think is built on what I call the 3 Fs. The first is the dollar's financial ecosystem. And foreign investors, when they're looking around the world, where else do you go to get a broad array of financial assets in every imaginable class of assets at every level of risk that's anywhere close to comparable to that which is in the United States. So it's this really attractive financial system that we have in this diversity of assets. And I think a particularly poignant point, which gets to this discussion of the equity market, is over the last, let's say, a generation, and maybe longer than that, the United States is the place where innovation happens. And we are seeing that in a big way in this AI revolution that is, lifting, we'll all agree, lifting equity markets, and maybe even would agree on the word inflating equity markets. But the financial ecosystem is key. I think another key factor, it's the second F, is the familiarity of the US system, or if you will, the benefits of incumbency. The reality is foreign investors know the dollar. They know US assets. They know the US regulatory environment. They know US markets. They know the features of US law, and on and on. They have those networks. They're operating here, and it's costly to move and set them up someplace else. So familiarity is powerful. And then the third, historical, and I heard, I think maybe both Jeff and Mori kind of highlight this as a question mark, and I'll come to it, but has been the Fed's willingness to act as an international lender of last resort. And at some key times over the last 20 years, during the global financial crisis, during the European peripheral crisis, and then during the pandemic, the Fed's been willing to provide, yes, domestic liquidity, but also international liquidity through its swap lines. And I think that has provided another powerful backstop for foreign investors and an attraction to the US market. Finally, the final part of this argument is, well, if the dollar's to be supplanted, either gradually or rapidly, it's got to be supplanted by something. And as you look around the world, I would think that the principal competitor would be the euro, but particularly European financial markets are not as integrated, as consolidated, and really yet competitive with those in the United States, and I mean particularly those on the continent. And so it feels to me like maybe someday the euro can displace the dollar, but I'm not sure when. And then similarly, if we think about Bitcoin or gold as options, if you're holding it, what you're doing is you're holding it. You don't have that same flexibility to recycle it into a variety of instruments. Now, let me be more brief in this next part and acknowledge, I think has been as nicely articulated, that the old-time religion, I think, is intact to a point, but there are some challenges to the dollar that I think have emerged. And we've got to acknowledge them and have our eyes wide open. I don't want to sound Pollyannish here, right? So kind of as a longer term kind of structural force, and I think Mari alluded to this, you've got the rise of China and other emerging markets. As a result of that, there is a natural rebalancing that's happening in global institutions and the global system. It's natural in that context for some of the contours and features of the dollar's reserve currency role to be shaped and molded into change in response. For example, perhaps some of these EMs have different preferences for where they hold their reserves than the DM economies. I think it's also very natural for these economies to say, if we're trading amongst ourselves, it makes sense to denominate it in one of our currencies. And so some evolution in some of these, and maybe that is kind of a gradual kind of narrative where we become more multipolar, but that would be a very gradual narrative in which that happens. More imminently, and I'd say more urgently, some of these institutional issues have been well covered, obviously are occurring. The fiscal deterioration, one of the things that worries me about it is we're in a very bad place, and I see it as being joint work. It's a bipartisan project that we've been on to end up with these fiscal deficits, which by our reckoning are likely to be 6% of GDP as far as the eye can see. You know, maybe to further kind of quantify this, by our reckoning, these deficits imply treasury issuance in the coming decade of roughly $20 trillion, could be a little bit more. This issue is very much on the minds of investors. I can tell you over the last 2 years, probably the number one question I've been asked by institutional clients is, who's going to buy all the debt? And I think that there is a premium, and let me call it an issuance premium, in treasury markets already, over and above a traditional classical kind of term premium, that there's an additional treasury premium that I would measure at this point in several tens, 30, 40 bips. And I'm watching it to see if it gets larger still. So I do see that as a first order concern. And then, of course, you know, policy formation process. And again, indisputably, we've jerked and lurched from policy, from administration to administration. That move from Trump 1.0 to Biden was a huge lurch. And now the move from Biden to Trump 2.0, if anything, has even been a more significant lurch. And it's left the rest of the world saying, you know, where are these folks, in creating uncertainty? Along with that, increased questions about the U.S. commitment to its role in the world, as is highlighted by this tariff campaign, as several of you have emphasized. And having spent 18 years at the Federal Reserve, not as many as Steve, but still a significant period of time, you know, I'm also worried about Fed independence. So there are some things there to worry about. And then finally, I just want to echo an issue that Jeff talked about, and that is, as the tariffs came on, our expectation was, and I think this was uniform across the macroeconomic world, we're expecting that that would be a force that would further appreciate the dollar. And in reality, and instead, the dollar has fallen. And I can tell you that the narrative in markets is that this reflected an emergence of a risk premium in the dollar, and foreign investors need through this period at least to be induced to hold dollars. I had an additional riff here on some of the challenges that the BRICS would face if they tried to even take a small step of invoicing currencies, invoicing trade in a common currency. They have to agree which one. They're actually going to do it. If you have a surplus, what do you do? How do you recycle those earnings? If I'm sitting there with a bunch of renminbi, it's not as easy to invest that in renminbi assets. It's not as attractive as in dollars. So even simple steps like kind of within the BRICS set of nations, invoicing everything in a common currency is not an easy undertaking. But let me leave it there. Kind of bottom line, I think the dollar is likely to remain the reserve currency for the coming decade for many of these reasons that I've emphasized, particularly the financial attractiveness of the dollar and the ongoing innovation, which actually should be dollar positive, both kind of structurally and cyclically during the coming years. But there are obviously a lot more question marks and a lot more to worry about than would have been the case if we had this panel 5 years ago.
Nathan, thank you very much. Once again, very rich presentation. You've raised many issues, but I just wonder about your confidence about the dollar. I'm just thinking about the last international reserve currency that went south, the United Kingdom.
Yes.
They had deep financial markets, innovation, the whole works. It was very attractive, but they seem to have got undone by the debt that they ran up during the Second World War, which led to their demise. I'm just wondering whether you see parallels here. Kind of like what's bothering me about the budget deficit is, as Mori indicated, something like foreigners already own a third of all treasuries. They own $8.5 trillion of the stuff. And we're now asking them to buy even more. You're talking about a 6% of GDP budget deficit for as far as the eye can see. So we're not asking them simply to maintain their level of treasuries. We're asking them to add to them at a time that we're going out of our way, to undermine the confidence, whether it's Fed independence or what have you. So I don't see how this all plays out happily. So that's just one set of questions. Second is, you didn't answer the question as to whether or not we've got a bubble in the stock market. That could have a lot of relevance. And the last point I'd raise is just your confidence about Europe. I'm just seeing that the second largest country in the Eurozone, France, has got these intractable problems. It's got political dysfunction, and it's got the same problem that the other countries had during the Eurozone debt crisis, is they struck in a Euro straitjacket. So if they try to fix their budget deficit in a big way, that risks, because they don't have the offset of the currency depreciation and easy monetary policy. In fact, they've got the reverse. The euro's appreciating, and we're now asking them to correct their budget deficit. I don't see how that ends too happily either. But I'd be interested in your comments.
Desmond, that's quite a list of questions that you threw at me, and I knew that by striking a somewhat more optimistic tone, then maybe I'd trigger you. So fair is fair here. Let me address first this issue of the equity market, and I think a big piece of valuations is bullishness on AI. And a third of the capitalization of the S&P is related to that tech sector that's benefiting, if you will, the AI enablers or AI producers. And when I look at those firms, and I think we've seen it again this week, when I look at those firms, I kind of think you got to be a true believer to be buying them at this level of valuation. But by the same token, you got to have nerves of steel if you're going to short them. So that kind of leaves me as sort of like, well, I don't know. And Desmond, maybe you've got those nerves, but I'm not sure I want to short them. And I would have made a similar argument a year ago, and I would have lost a lot of money if I had shorted them. So that's one aspect.
Well, that's the Keynes observation. That markets can stay irrational for longer than you can stay solvent.
That may be true. But these firms, have continued on really, really brisk earnings trajectories, including earnings announcements this week. And I can't, given my role, I can't name names, but we know who they are. Eye-popping earnings announcements from some sets of firms. Now, I think a second factor that's at work, and I debate Citi's equity strategist on these issues, and he's, you think I'm bullish, you ought to talk to him. But I think one of the things that's happening is throughout the equity space, you've got a lot of investors looking at the fundamentals of these companies, their business strategy, their competitiveness, and their prospects. And these kind of micro-based investors are pretty bullish about what they see in the U.S. corporate sector. And I think that kind of bottoms-up bullishness is another factor that's at play in these valuations. So, the way I put it, and somebody asked me a question similar to that, kind of with a little bit of AI bullishness, which is probably justified in my view, a recognition that U.S. corporates really are in a good place and they're weathering the storm. and likely to come out of it in a good place. You can probably get to, an R squared of 0.75, in my view, for these valuations, but there's still a kind of a meaningful component of unexplained price gains. So when I want to debate a valuation of, the S&P of 65, 6,600 and try to tell you why it should be that instead of 5,800, I wouldn't. But I think that the fundamentals that I've discussed are probably enough to tell me why it's not 4,500. So that's my effort at your at that question. I love your question on the UK and the UK currency status. And I think the key point is, UK ended World War I with enormous debt loads. And it wasn't until after World War II, and I would argue at a point where the UK economy was struggling, especially relative to the economic engine in the United States. It just became so clear following World War II who was the dominant country. And only then did that reserve currency status pass. And, if you want to draw an analogy with the United States, maybe we're more like the UK in 1920, which means we still have 20 more years of challenging policies before, we actually lose it. But at this point, I think our underlying economy, if you look around, whose underlying economy do you like better than that of the United States? And that kind of gets, and recognizing we have plenty of problems and we've got governance issues. But, and I think that's what investors are doing in the private sector as they allocate their resources and making these decisions. Are they thrilled with fiscal? No. Are they thrilled with tariffs? They're not. But where else, where else are you going to go? So that negative argument of, well, there's really no one else, is pretty powerful. And then let me just address very briefly, you said huge deficits, who's going to buy? And I think you're right. I don't think it's going to be a big slug of foreign official investment that's going to come in and take care of it. But in the chart, I think it was the Mori showed, that share has kind of leveled off at around 30% over the last years anyways. And I think ultimately it's going to have to be private investors in various places in the world. And maybe if the US is a more dynamic economy, it can offer higher real returns on its assets. And there will be a higher marginal product of capital, and that will attract more foreign investment. But this issue of who's going to buy it is one that keeps me up at night. One final thought there is, you will have through this period, a larger share of the population will be approaching retirement and entering retirement. And those folks will be looking for, relatively safe assets to save, to mobilize wealth, to move it through or protect it through time. And then our debate is whether they'll view treasuries as quote unquote relatively safe. And maybe that's ultimately the debate we're having today, is can we continue to think of treasuries as being still, not categorically absolutely safe, but still relatively safe, or should we be even more worried than that?
Oh, okay, we didn't get to Europe, so we'll come back to that maybe later on. But just if I could add one point, that kind of bothers me on this US bond market, is that this administration is making statements that really must be undermining foreigners' confidence in buying US treasuries. That the two statements, in fact, it's not a statement. I'm thinking of that famous Section 899 in the big beautiful bill, which said that Trump could impose a tax of up to 20% on interest payments to foreigners if he doesn't like the tax policy that their country is following. That's got a risk. And then this Mar-a-Lago Accord, or you get from people like Moran, they frequently talk about, maybe it's a good idea to convert all of these bonds into a 100-year zero coupon bond. That can't be too comforting. When you're asking people to buy boatload of more of this stuff, and you're threatening, not to honor your commitments. That is another reason, that I'd worry about this Treasury bond market. But Steve,
Yes.
the floor's yours.
Thank you, Desmond. This has been a great panel. I have to say, I've already had many interesting thoughts that I didn't have before it started. And I want to thank Desmond for allowing me to invite myself to this panel. I will now endeavor to do the most difficult thing an economist can do, which is to share one's screen. Which of these? I'll try this one. I think I need to go back a little here. All right, good. All right, so I will actually follow up on the issue Nathan raised of the old-time religion. So for years until this year, my former Treasury colleague, Mark Sobel, who I'm sure you all know, and I have been writing papers explaining that dollar dominance is here to stay for the foreseeable future. Because for all the reasons that Nathan outlined in his presentation. But this is a new year and things seem to have changed. And the mood, the vibes are different for a lot of good reasons. So anyway, so my talk is titled, Did Liberation Day Sound the Death Knell of Dollar Dominance? Desmond wanted me to come up with a flamboyant title, but I'm kind of sticking to the science here. All right, so and so this is going to basically address the question of have things changed? So my next slide is just kind of just explains how dominant the dollar has been. As you can see by the red bars on the left, the U.S. economy represents a reasonable but not huge share of global trade and GDP. But as you see by the blue bars on the right, the dollar, represents a huge share of international financial transactions. And, that's the basis for what we call dollar dominance. Okay. And one of the key reasons for that, of course, is the perception that U.S. Treasuries are super safe, as we've discussed. So what happened on Liberation Day, April 2? When Trump announces his sweeping reciprocal tariffs? Well, as you can see by the orange line, the VIX, the measure of financial volatility in equity markets, soared in response to the chaotic announcements. And the dollar, represented here by the DXY, dollar against foreign major currencies, with an increase in this being an appreciation and a decrease being a depreciation, plunged. Okay. And so that, so ordinarily, because the dollar is considered a safe asset and a flight to safety asset during times of volatility, the dollar would be expected to rise. And so when it fell, instead of increasing in response to the Trump chaos, there was a lot of commentary in markets that basically the dollar had switched from being a safe haven currency to being an emerging market style kind of risk on type currency. And in this risk off environment, people were selling off the dollar. So that was kind of like the perception of market commentary. And my question, that I want to address is, has this change in behavior persisted? Okay. In other words, has the dollar continued to be an emerging market style currency rather than playing its traditional safe haven role? So in order to assess that, I do what economists like to do, which is to run regressions. Actually, my research assistant does them for me. And so I regressed the value of the DXY dollar on, as you can see in this table, the 2-year differential between our interest rates, yields, and foreign yields, the difference in our yield slope, 10-year minus 2-year yields here and abroad. and the volatility index, the VIX, okay? And as you can see, all three coefficients are significant, as indicated by the same three dots that Jeff Frankel uses. And, and it's a perfectly reasonable regression. And so with that, I'm showing here a comparison of the level of the actual dollar, that's in green, with the in-sample fit, the predicted value of the dollar, shown in red, okay? And as you can see, the predicted value goes up and down more or less well with the actual dollar. And then kind of like focusing on the last year, you can see that the dollar actually rose more than the model predicted in the lead up to Trump's inauguration. And that was the so-called Trump trade. Everybody was very optimistic. And then even before Liberation Day, basically as the water came off the boil of the Trump trade, the dollar started falling. And then after Liberation Day, the dollar plunged. Even as the predicted value basically kind of moves sideways. And kind of like that's where we are at the moment. Now, this by itself could be taken as an indication that investors are rejecting the dominant role of the dollar in international markets. But I think that would be to go too far. There's various other explanations for why the dollar might have fallen more than predicted by interest rate differentials in the VIX. One of them that Jeff Frankel mentioned was that maybe investors are worried about inflation, okay? And so that would tend to simultaneously depress the dollar, but raise interest rate differentials. So rather than focus on that as the metric for kind of like investor attitudes toward the role of the dollar, instead I want to focus on what I alluded to before, which is the dollar's safe haven behavior. So as noted here, because the dollar has been the premier safe asset, when volatility rises, investors traditionally have piled into it and the dollar goes up. So by the same token, a weakening of that safe haven behavior might signal some weakening of the dollar's status as a safe asset. And thus, it's not this now safe asset is not the same thing as a dominant currency, but basically dollar safety supports dollar dominance. Okay, and so what I'm going to do is just show how basically the safe haven behavior of the dollar as measured by the dollar's response to the VIX. And that's what's shown in this chart. It's basically just the coefficient in the dollar regression on the VIX, okay? Basically, estimated for 30-day move, 30-day windows, moving overlapping windows over the course of the last few years. And what you can see by that blue line, which represents that sensitivity, almost always above zero, with a few exceptions before Liberation Day, suggesting again the dollar was a flight to safety asset. Then the dollar plunged. Okay, excuse me, not the dollar. The sensitivity plunges from positive to negative after Liberation Day and stays there for a while, indicating basically again this kind of like rejection of the dollar's safe haven role. So markets were shocked, so chaotic, they pulled back. But the interesting thing here, perhaps in support of Nathan's point, perhaps not, is that the safe haven behavior of the dollar reverted. It's back, okay? So that coefficient goes back to positive, meaning that somehow markets have gotten over it. So what do we make of all this? All right. Well, as I just said, as financial markets seem to have acquiesced, this is the frog in the boiling water story. The safe haven behavior of the dollar is reverted. My view is that in the near term, basically, unless there's another salvo of crazy policies like Liberation Day, global investors are going to continue to consider the dollar a safe asset and the dollar's dominance in the savings sphere, as well as in pricing, invoicing, payments, etc., will remain. But this is like in the near term, and in the longer term, if all the types of policies that my predecessors on the panel have already complained about basically continue, okay, And if, Trump, succeeded by other presidents, continues to keep our debt on its steady trajectory into the stratosphere, I could see the dollar dominance, eventually eroding. Now, the final point I'd like to make, which is not on this slide, is we haven't talked too much about, well, let's say that the dollar loses its dominance. Is that a big deal? And my view is you can imagine situations where technological improvements in the finance sphere, as well as strong growth in other economies, leads to a more multipolar currency world where the dollar is less dominant. But in that prosperous scenario, not a biggie. Okay. I don't think that American prosperity relies on dollar dominance. But as is often been said, if dollar dominance is lost because of all the factors listed on this slide, well, then the loss of dollar dominance will be the least of our problems. And I will stop there and even try to stop sharing my screen.
Before you stop sharing your screen, I wonder whether you could go back to the first graph that showed the VIX and the dollar.
Sure. You mean the very first one?
Yeah.
All right. That one.
Yeah. I guess the problem I've got with this is that we've really only had one test of huge volatility in markets. That was on Liberation Day, and the dollar failed, that we would have expected the dollar to rally, and it declined. We haven't had a second test. I don't know that this really proves anything. A different way I could put it is that I would have expected that once the volatility stopped, the dollar would have gone back to its pre-Liberation Day level, and we're not seeing that. So I don't know what I'm missing.
Well, first of all, I'm not trying to prove anything, so you're not missing anything. I'm just presenting the facts, ma'am.
Right.
But let me follow that. So let's put it this way. There's a couple of issues. Number one is it could be, and you could be exactly right, that we will not observe basically a failure of dollar safe haven behavior until we have another major bout of volatility.
Right.
So it could be that global investors have already kind of like rejected the safe haven role of the dollar, but it's just not apparent because volatility is so low.
Right.
I take that point.
Steve, I'm told that we've just got 10 minutes left, so I'd like everybody just to comment on one another's, whether they've got any observations, just to close this out. But we've got a couple of questions from the audience. One of them, when you make the final comments, one comes from somebody who I think's some of your former bosses, Ted Truman, who's asking, aren't we or you stressing the reserve role of the dollar too much? Isn't that role now the tail, not the dog, and the tail does not wag this dog? My view is that it is the market use of the dollar that is most important, and disturbances to the market's use of the dollar is the key risk. So, Mori, I don't know whether you've got some final comments to make, having heard everybody else and having heard Ted's question. Would you like to make some closing remarks?
First, unmuting yourself.
Thanks for that useful reminder, Steve. Yeah, let me just say a couple of reactions to things that have been said. Not really, I wouldn't dignify these as closing remarks, but they will be my last remarks. Yeah, Ted is totally right. People hold the dollar in reserves because it provides these useful functions. And so the reserve holdings, I think, really are very much the tail of the dog. Just 2 points. On Steve's presentation, there were a number of very breathless analyses of short-run high-frequency data that came out right after Liberation Day saying, oh my God, things have changed. But if you look 2 weeks later, things hadn't changed that much. So I think the point is that markets are really volatile, and I think we're in a transition. One piece of data I looked at recently is net foreign purchases of treasury securities, and they plummet in April, but then they shoot up in May. And you could say, oh, we're back to normal, but they plummet again in June. And I haven't looked at the July data yet, but I think
Isn't
that
there
the
a Frank
nicer,
Sinatra song, Riding High in April, shot down in May?
oh, wow. Well, I guess you're right with the sign change. But we have to keep looking at July and August and September, and I think that it's hard to say what the trend is from those data because it's an evolving situation. Second point I can't resist making because Jeff is here. There's a question about long-term interest rates in the dollar. There's a very robust relationship, which Steve showed, in which higher long-term interest rates strengthen the dollar. But we have to remember that we have been in an environment for decades of anchored inflation expectations. So these changes in long-term interest rates are actually changes in real interest rates. And when Jeff and I were in graduate school, Jeff wrote in his dissertation a very famous paper called On the Mark. It was in the very inflationary environment of the 70s, where he pointed out that what matters is real interest rate differentials. And so, in an environment where the Fed is being threatened, where fiscal dominance threatens, we can no longer take for granted that the historical relationship between long-term nominal interest rates and the dollar will prevail. Life becomes much more complicated. That's
Thank
all
you.
I got.
Jeff,
Well, I'm very happy that Maury remembers my paper of 30 years, 50 years ago, by God.
Just trying to show you how old you are, Jeff.
Right, almost 50 years ago. Um, on Ted Truman's question, yeah, we've been talking about the international role of the dollar, particularly as a reserve currency, because that was the topic, and that was our assignment. But I would tend to agree with the assessment that it's sort of less important than two big questions with which it has partial overlap. One is U.S. macroeconomy, and can we go on running such big budget deficits, and implications for the level of the dollar, which, as a few people have pointed out, is distinct from the international use of the dollar as an international currency. And they at times have moved opposite directions, even though there is the link. And the other huge topic is U.S. leadership of the post-war, multilateral, open, liberal economic system, and beyond economic security system as well. And I think if the role of the dollar is just one aspect of that, both a symptom and to some extent a tool. I mean, I read in the paper today that U.S. is able to use the dollar to enforce its will on, or try to enforce its will on Brazil with regard to Bolsonaro, which is kind of a strong imperialist misuse of exorbitant privilege to the extent it's true. But the prosperity and the relative prosperity and peace that we've had over the last 70 years in the world, with U.S. leadership, to be sure, at times faltering or making missteps, that is just tremendously important, unprecedented in human history. And the possible decline of the international predominance of the dollar is just one small chunk of that.
thank you. Nathan.
Let me just echo. I think that last point that Jeff was making is really important and really persuasive. That this big question of what is the U.S. role in the world in terms of economic policy, financial policy, but more broadly, and if the U.S. pulls back from that and is less inclined to be an international leader, what are the ramifications of it for some of these issues, particularly with respect to currencies that we've been debating today? Maybe it's a corollary to that, and maybe in slight tension, I also want to agree, though, with Steve's point that at the end, that U.S. prosperity does not, to a first order, hinge on whether or not we're the reserve currency. And indeed, a number of our former colleagues have made arguments that the reserve currency status may be a challenge for U.S. economic performance and create difficulties for the U.S. economy for growth and definitely external performance. So I think that's an important point as we debate it. It's important for the world. It's important for how the financial system works. But I think the U.S. economy would adjust. Whether there might be some disruptions in financial markets through the adjustment process. The new equilibrium, I don't think would be any worse. But what the adjustment would look like is maybe the caveat for us to think about more. And then finally, I think Ted's question summed things up extraordinarily well. And I tried to get at his point by arguing that the size of foreign participation and the robustness of foreign participation in U.S. financial markets was a key factor reflecting and reinforcing the reserve currency status. But he may very well be right that maybe the foreign participation is kind of the dog after all. And that may be the root and core of why I feel maybe a notch more optimistic than some here, notwithstanding the fact that there is a veritable litany of things to worry about right now.
Steve, you've got the final word, but before I give you the final word, can I just read a comment, coming from Mark Sobel, that you might want to comment on. Out of curiosity, given the title of the event, do Mori, Jeff, and Nathan believe that the US dollar has had an exorbitant privilege, or are there costs associated with dollar dominance and it is just a net plus or net minus? Steve Moran's Mar-a-Lago Accord seemed to suggest it's an exorbitant burden. I don't know if you want to comment on that.
Desmond, are you, first of all, can we go over a little bit? And are you asking our other panelists, which would be fine by me?
No, he's not.
I'll say there's some drawbacks, but on net, it's a benefit to have your currency as an international currency.
Well, I would have thought the benefit is that you can live beyond your means forever.
Right.
So let me just say, so Mark and I have, written a lot of screeds on this, and the points that we have made, I don't know if Mark still stands by them, is that in terms of these strict economic benefits from having a dominant dollar, they're positive but not huge. A little seigniorage, somewhat lower interest rates, somewhat greater buffering from external currency shocks. We made the point that the real advantage actually is on the geopolitical side, the ability to actually weaponize the dollar, to punish bad actors abroad. Now, if that weapon is used wisely, then that's a great benefit. If that weapon is used not so wisely, which might be the case more recently, then it's a problem. But that said, that's why I would not bemoan the loss of dollar dominance if it were due to benign factors like technological developments and global prosperity. But I would bemoan it if it just signaled the breakdown in our country's own kind of like economic and political, prosperity.
Thanks, Steve. Just let me thank everybody for really what was a great and stimulating discussion. I've really learned a lot out of it, and I hope our viewers got something out of it too. And I would just propose that we reconvene this group in 20 years' time to see whether the dollar really maintained its dominance. So until 2045, I'll just wrap this up. And once again, thank you very much.
Are we done?
Yeah, we're up there. Really, that was